The global semiconductor war is usually discussed through the lens of giants. We talk about TSMC in Taiwan, Samsung in Korea, or Nvidia in Silicon Valley. But there is a quieter, yet critical battle being fought on American soil. It is a battle for technological sovereignty. The ability for the United States to manufacture its own critical chips for spies, satellites, and soldiers. At the center of this battle sits a relatively small, often misunderstood company in Minnesota, SkyWater Technology. Today, we are doing a deep financial dive into SkyWater Technology, ticker symbol SKYT. We have combed through their annual reports from their IPO era in 2021 through 2024, and analyzed their latest quarterly filings from the first, second, and third quarters of 2025. This is the story of a unique business model that blends research lab innovation with factory mass production. It is a story of government contracts, radiation-hardened chips, and a difficult quest for profitability. Let's start by defining what SkyWater actually is. Most foundries, like TSMC, are volume businesses. They want to make 1 billion copies of the same iPhone chip. SkyWater is different. They operate a model called Technology as a Service, or TaaS. They don't just print chips, they co-develop them. They allow innovators, whether it's, say, quantum computing startup or the Department of Defense, to come into the factory and develop custom processes. This model is split into two revenue streams: Advanced Technology Services, or ATS, where they get paid to develop the tech, and Wafer Services, where they mass produce it. Looking back at the historical data from the 2021 and 2022 10K reports, we see the foundation being laid. Revenue was growing, driven heavily by this ATS model, but the costs were immense. Building a semiconductor fab is expensive. Maintaining it is even more expensive. The company was burning cash to upgrade its facility and install new tools, betting that these R&D projects would eventually turn into high-volume manufacturing wins. By 2023 and 2024, the narrative began to tighten. The geopolitical tension between the US and China became SkyWater's biggest tailwind. The US government realized it couldn't rely on Asia for chips used in fighter jets or the power grid. SkyWater became a trusted foundry accredited by the Defense Microelectronics activity. This is a moat. Not everyone can get this clearance. Now, let's fast forward to the data that matters most right now. The 2025 fiscal year. We have the Q1, Q2, and Q3 202510 Q reports in front of us. What is the financial reality today? Throughout 2025, we see a company in transition. The revenue has been stabilizing, but the mix is shifting. The ATS side, the research and development revenue, remains the primary engine. In Q3 2025, for example, ATS revenue continued to be the dominant contributor compared to Wafer Services. This tells us that SkyWater is still very much an innovation engine, rather than a traditional mass production factory. A key highlight in the 2025 filings is the progress on the Rad-Hard platform, specifically the RH90 technology. These are chips designed to survive the brutal radiation of outer space. With the explosion of the commercial space industry and the creation of the Space Force, demand for these chips is real. The reports indicate that this technology is moving closer to productization. This is critical because product sales usually carry better long-term margins than service contracts. However, let's look at the bottom line. Profitability remains the elephant in the room. In the first 3 quarters of 2025, SkyWater continued to report net losses. Why? Because the depreciation of their equipment and the cost of running a specialized fab in the US are high. Their gross margins have fluctuated. In the semiconductor world, if your fab isn't running at full capacity, your margins get crushed by fixed costs. We saw this pressure in the Q1 and Q2 2025 reports, where inflationary pressures on labor and materials also weighed on the numbers. But it's not all red ink. The company has been managing its cash flow carefully. They have utilized their revolving credit facilities to maintain liquidity. And crucially, they have received significant funding support from the Department of Defense. This isn't just revenue. It's often capital investment that SkyWater doesn't have to pay for entirely out of its own pocket. This government backing effectively de-risks their balance sheet in a way that a purely commercial company cannot match. Another strategic pivot we observed in the 2025 documents is the focus on heterogeneous integration. This is a fancy term for stacking different types of chips together. SkyWater is positioning itself not just to make the silicon, but to package it in advanced ways. This aligns perfectly with where the industry is going. As Moore's law slows down and advanced packaging becomes the new frontier for performance. So, What is the verdict for investors looking at SKYT? This is not a stock for the impatient. The financials from 2021 to 2025 show a company that is slowly proving its unique model, but has not yet reached the escape velocity of consistent profitability. The wafer services revenue, the mass production side, needs to grow faster to balance the business. However, the strategic value is undeniable. As the US government pours billions into the CHIPS Act and defense modernization, SkyWater is one of the few pure-play vehicles to capture that spending. They are the pick-and-shovel play for American semiconductor independence. If you believe that the trend of reshoring manufacturing will continue, and that the militarization of space is just beginning, SkyWater represents a call option on those themes. The risks are execution and cash burn, but the opportunity is to become the boutique foundry for the US national security apparatus. The year 2025 has been about stabilizing the foundation. The question for 2026 is whether they can finally turn those R&D contracts into millions of chips shipping out the door.